All right, let's get rolling here. So this is our weekly mortgage info session that we've been doing here the last few weeks and plan on doing in perpetuity every Wednesday at 2 Eastern. And if you have missed any of the past ones, they're all on a playlist at the Wake Up Real Estate YouTube channel, or you can just reach out to me or Mike at growwithjosh.com, and we can get you that information and any of the replays. We've covered a number of different topics and different programs, etc. Today, what we're going to be digging into is at least 5 ways that you can help buyers purchase with zero down. Now, that doesn't mean zero out of pocket per se, right? There's going to be some costs, right? But what we mean with that is essentially 100% LTV in some form or fashion. And so some of what we're covering is programs, and some of what we're covering is more sort of strategy, let's say. I'm trying to make this, how do we make it so that, well, maybe it doesn't matter. I was trying to highlight you and I, Jordan.
It looks like we are. I don't know.
Oh, we are? Okay, maybe it's just my view. It's probably just my view. There we go. Okay, I got the speaker view now. So a couple last things. We are recording this, so we will get this out tonight or tomorrow morning at the latest to anyone who registered. So if you want to take a second look at this, and there already are some resources that you can leverage around this idea of zero down financing options at wakeup.realestate. You can go there and create a free account. There are lead capture pages around mortgage programs, some of which are programs that we'll cover here and highlight here today. There are also scripts you can use around some of the concepts here today. And so if you go there, wakeup.realestate, create a free account. If you can't find those, just use the little chat widget that you'll find at the bottom right of the site. And Mike or someone on the team can point you in the right direction. For those of you who don't know, my name is Josh Shanley, and Jordan Syers and I, and actually we have a whole bunch of other members of the team, are part of the virtual mortgage partners team at Axon and Nexa Mortgage. And we've had the pleasure of working with a whole bunch of you on here in the past few months to build pipelines, to convert pipelines, to help clients, etc. And so we appreciate all of that. And so without further ado, Jordan, why don't we get into the 5 programs? And we want this to be interactive. So if you have questions, you can post in the chat, or if you can raise your hand and we can unmute you. This isn't, there's no sales presentation here. This is an info session, so we can educate you, that you can have smart conversations and better conversations with potential clients, and hopefully refer them our way so we can help them and bring them back to you as pre-approved, ready, willing, and able clients. All right, enough sales pitch and housekeeping. Let's get into the good stuff.
Okay. Let's go over, some of the, initial ones that are very common. DPA. Yep. Let's talk about DPA a little bit. DPA is across the board, can be for most people associate this with FHA. Okay. Typically, DPAs are associated with FHA mortgages, but it doesn't necessarily mean that you can't, yes, down payment assistance. Thank you, Josh. That you cannot use them with conventional loans. We do have products out there that are for conventional. DPAs, typically when we talk about our pillars, right? I always like to talk about pillars anytime we're talking about financing, because at the end of the day, those pillars are going to determine whether or not they qualify: income, assets, credit. On DPA, if we're missing, assets, that's essentially what we're missing. We need the 2 other pillars. So we need a decent credit score, usually, okay? A decent credit score and decent income. So our rate.
Hold on, Jordan. So when you say decent, can you put some?
Decent, 620, 630, 640, right? Okay. I had someone the other day that literally looked at me and told me her credit was shaky. And she had a 710. So decent to us is really 620, 630, 640, somewhere around there in the 600s, low to mid 600s. Income wise, we do it that based off a ratio, but they do require tighter ratios. So DPAs themselves are really, really good product. You can do a lot of them. We go down to 580 on a lot of situations, but they would have to be manual underwrites. Okay. Manual underwrites are more difficult. There's more paperwork with them. There's more hoops to jump through. But with that being said, there's such a thing called a TBD underwrite, to be determined. That means we can actually take them through the mortgage process ahead of time on those manual underwrites, and actually have it approved before you go shopping. Right. So especially when it's a DPA program that's adding into the mix on top of a manual underwrite, we definitely want to make sure our ducks in a row are in those. Okay. So that is probably the easiest one. That one is going to be the one that is the most commonly that people know is down payment assistance programs.
One thing to add there. So as I mentioned, resources around these topics, there is a lead capture page specifically around FHA DPA, FHA down payment assistance, and using that as a hook that you can generate more leads or re-engage or revive existing leads or your database. So if you go to wakeup.realestate under, well, I'll just show my screen here. I'll show you where to find. There's a tab called Lead Capture Tools. And here it is. So lead capture tools. Okay. Lead capture tools. You just create a free account at wakeup.realestate, lead capture tools. And there's a whole bunch of different tools here. But you can see a growing list of lead capture pages around financing or mortgage program options. So you just click on mortgage lead capture pages, and it's actually the first one listed there. I didn't even realize that, but right there, FHA down payment assistance. There's a short little video from yours truly, and then a long form submission, kind of like a survey that they can fill out. And when they do, that becomes a lead for you, and our team will work on your behalf to get them warmed up, pre-approved if possible, and sent back to you so you can go find them a house. So that's number one, DPA. Yeah. Next.
Number one. I want to go into the more traditional products, and then we're going to talk about strategies, really. Traditional products in certain areas is USDA. Okay. USDA is a common one for a lot of Midwest states. If you're in a higher populated area, obviously this isn't going to work. But USDA is a really, really, really good product in the terms of getting people to qualify, because the credit score requirements on it is still around 630 to 640 probably. And then the debt to income ratios are a little bit tighter on that as well, but it is 0% down. The rate's really good, and the mortgage insurance on USDA is very good. There's actually an eligibility tool that you can use to look up. I'm going to actually put it in the chat.
Okay, you have that, because I was actually looking for that.
Yeah,
it's great. You can put in the address of the property, and it'll tell you whether or not that the property, it doesn't mean the borrower will, but that the property is in an area that is USDA eligible.
Correct. So I just put that in there. If you click on it, you click accept, it'll just come up with a big map of the United States, and you just put the address in it, put your own personal address in it, and then it will tell you eligible, not eligible. Super easy to use. You'll look at the states as a whole, and you'll be surprised on how much space actually qualifies for USDA.
That's what I was just going to say. Don't assume anything. Don't assume that because just don't assume anything. It's always worth at least plugging it in there and seeing. And the border lines are crazy, because you can have a property. I've had it in my local area here, a property where, on one side of the road, it's USDA eligible. Literally on the other side of the street, it's not, right? So, check it out, play around with it, punch in some addresses, punch in your own address, and just see, just play around with it.
Okay. All right. USDA, really good product overall in the terms of getting it underwritten as well. We do use a different system, but at the end of the day, they did a really good update with the most recent updates on when we moved to the 3.4. So it's actually a much quicker process than it used to be. A lot of people associate with USDA as this long drawn out process. We can easily close them within 30 days. Okay. So they're just like a regular loan at this point. And it's it used to be where it was much longer. I would usually ask people to do 60-day contracts. But that's not the case anymore. So I've called, they usually only stay at USDA for about 2 days on average now. And we can call and pick up the phone and ask. So when you're talking to us as an originator, especially when you're making an offer, that is one thing, even if it's not with us, if you have a USDA pre-approval on a listing, anything like that, you can actually call USDA and find out what their turn times are. So they would prep that entire file, put it together, and then they send it off to USDA. If it's 7 days, you got to take that into account. 7 days is definitely going to be a struggle to make a 30-day close, where 1 or 2, not a big deal. Okay.
Perfect. FHA, DPA, or DPA, where it doesn't always have to be FHA. We've got USDA. What's next?
VA. We've already talked about this.
Yeah.
But I think it's a good refresher because VA, I think, is the most aggressive of what I call the normal loans, USDA, FHA, conventional VA. By far more aggressive. They don't have a credit score requirement. It's 0% down, and they also don't have a debt to income ratio requirement. That doesn't mean the system will say yes, right? There are, it's not like everyone's approved at the end of the day, but on the products themselves, it is by far the easiest to get someone approved if they have higher ratios or if they have, lower credit scores. But in reality, we typically want to see them in the low 600s at minimum, at least, as well. Okay. Unless they have really, really good ratios and they have really, really long history or something, then we could probably get away with 500s.
Couple follow-ups. Number one, we have an entire session on VA that was a few weeks ago, and it's on the Wake Up Real Estate YouTube channel. There's also a link at the wakeup.realestate site, and that has also been built out. There are some additional resources that Ryan has created around this. And in fact, we have ad campaigns running right now to build a pipeline of VA borrowers or VA eligible potential clients. If that is something that is of interest to you, go to vqualifier.com, check that out and get signed up. And then once we start your onboarding, let us know that is an audience that you would like to, or a niche that you would like to build a pipeline around, and we can absolutely help you with that. Obviously, it's an audience that is well worth serving them for the service they provide to our country, and it's a wonderful program. And in that past session, if you missed that, we talk about how they can even use that to build an investment portfolio. So you can help them grow their wealth using that program. So more resources on that. And for those of you that came in late, we are recording this, and the recording will be sent out to everyone who's registered later tonight or tomorrow morning.
I don't want to say her name wrong. I'm halfway sick, and Quantine is asking for the link for VQualifier.
Oh, yeah, it's just vqualifier.com. I will put it in the chat right now.
You said it correctly.
I said it correctly? Okay, that's a first for me. I'm going to tell you that right now. Josh will tell you I mispronounced his name for a year. So, I probably did it yesterday.
Yeah. All right, USDA, VA. What's next?
Okay, next I would do, this is my favorite one by far, okay? I love this one because people don't think about it a lot. Gifts of equity. Okay. So gifts of equity are almost on all products, but conventional and FHA is the most traditional. And it's essentially where you're buying from a family member. There's a list on FHA of what family members, and this includes in-laws, grandmas, grandma in-laws, brothers, sisters, stepbrothers, stepsisters, kids, daughters, whatever it is. It pretty much goes out to where it stops around cousin. Okay. But for the most part, if you have a direct family member, you can gift them the equity in your home or a certain portion of equity And a lot of times we'll build that into a contract. So if you have someone that is I don't know, let's say Monica, I just, I can see Monica. So Monica has a client and her daughter wants to buy the house. I immediately tell them you can do that for $0. You don't need a single penny to do it. It just depends on how much that property appraises for, number one. Okay. And number two is parents willing to help them, right? Or, or is grandma willing to help them? We will always typically build it into the contract. Okay. Put that together in the contract to see if it will appraise out. If it doesn't appraise out, that's when we adjust it. But if we don't ask for it for an appraiser, we're not going to get it, essentially. So it's built into the contract. We actually write it on the contract, how much they're purchasing it for and how much their mom, brother, sister, or whoever is gifting them in equity. That can be used for closing costs and down payment. So when I say it's really $0 out of pocket, my very first loan that I did ever in my career was a gift of equity loan. And I was taught about how to do gift of equities. And we did it and it cost $0. There was no money involved at all. So
raise your hand if that is a new concept to you. I would guess that some of you on there didn't even realize that was a potential, opportunity in, it's not going to work in every scenario. But
it is almost identical. So someone said in the chat, it is similar to gift funds. It's almost identical. Where it is not identical, gift funds can actually be given on FHA for long-term friends. So if you can prove friendship for years, right? So I have friends from high school that are in the mortgage industry. They could gift me the down payment and closing costs to buy a house. That is the only difference. So you can't do that with long-term friends. But yeah, it's almost identical. Yeah.
Yeah.
How do I pay? I want to buy a small house, but I want to set payment. Okay. That is a question I can answer at the end. That's more directed to like qualifying someone.
Which, by the way, if you have situations or scenarios, etc., that's what we will have. I should have mentioned at the beginning, we will stay on for Q&A at the end. You can, if you have situations, scenarios, questions, etc., that I think in many cases is the most valuable part of these sessions, right? Because it gets you thinking and the gears turning. Okay. Down payment assistance, USDA, VA, gifts of equity. What's left?
We're going to go over three things, okay? Because there's three main differences on these. Okay, these are more strategy at this point. Peterson will answer that at the end because that's going to be a little bit longer question. But let's talk about these three unconventional strategies or whatever. Most people have heard of taking equity out of a current house and being able to buy another property, right? We're in a market where houses are appraising high. We're in a market where they do not want to refinance, but maybe they want to buy another home. If it were, with me, right, on my house, and I have a 2.2%, I don't necessarily want to give away. That's free money to me in my mind. Give that away. So people will just take a portion of their house or their equity. Let's say they have a 50% loan to value or whatever. They can pull out up to 80 to 90%, typically, depending on what type of loan. It could be an investment property, could be a primary residence, could be a second home, doesn't matter what it is, but they could do either a HELOC, a second, or a total cash out refinance where you're refinancing the whole thing. Okay, so those are three options essentially to pull out that equity and purchase a new home. So let's talk about the three. A HELOC, a home equity line of credit. This is probably one, I did a podcast recently with someone on this and we went deep on it. But this is probably one that we'll eventually do a webinar over. But it's a home equity line of credit. It's a line of credit that can be used multiple times typically, or once, just depends on the product itself and the lender, that you pull out X amount of dollars from your equity. And then you can take that, turn it around, put it on a new house, put the down payment on, pay the closing costs with it. I'm doing that currently with a loan in North Carolina. 2 loans. We're getting 2 transactions out of it. but we couldn't figure out how to get them to qualify. So a lot of those programs are no income requirement programs. So they wanted to buy another investment property. We cashed one out, pulled out $92,000, turned around, buying another property, right? So got two deals in one there. But that is just one example of using equity as a vehicle or a tool to go buy that next property. Now, you can do full-on cash outs where you refinance the whole property. Maybe they don't care about interest rate. Maybe it's something where they have a 10-year mortgage on it and they want to extend to 30 years and their payment, even at a higher interest rate, will still be lower. We can look at it from that perspective. Cash out, that's usually up to 80%. There are second mortgages, which is more like, it's not a HELOC. It can't be reused. It's just a second mortgage. So you go there and you pull out $100,000 on a property, but it can't be reused. It gets paid down. It's just like you have a second mortgage payment on that property. So those would be the main three.
And I don't know that this, this might be stretching a little bit, but what about folks that they take a loan from their 401k or retirement account?
Yeah. Absolutely. Yeah, I mean, we do that all the time. So that's usually tax-free. They usually have an option
down because they're getting the money that they already have, but it's, it's not money that they have to write from their checking account, let's say.
The other thing that a lot of 401ks also are tax-free. So there are situations where someone pulls from their 401k and gets hit with a hardship. It depends if they've already pulled from it, if there's a loan on it. But 9 times out of 10, if you have a 401k and you have money built in it, they let you draw from it at zero tax in order to purchase a house. So it's it's a special provision for those 401ks in order to purchase a house.
Yeah.
Okay.
So we have down payment assistance, we have USDA, we have VA.
Mm-hmm.
Gifts of equity or gift funds, and then we have leveraging existing equity, right? So, and several ways to do the last two. So now let's sort of open it up for Q&A and scenarios, situations, etc. Peterson asks, who qualifies for a USDA loan, or how, maybe who? Or
so. Do you mind if I share my screen?
Absolutely. Hold on.
Okay.
And let me first say the property has to qualify.
Yes.
Right. That's why we gave that link at the beginning. Like the first thing you've got to do is determine, does the property at this address fall under the USDA eligibility?
So this will be one of the things we talk about with your clients. Okay. So especially with someone 0% down, when we're talking 0% down, I start going through the options, right?
Yep.
We just went through 5. Okay. So when you're out there pushing 0% down FHA, just because we're pushing 0% down FHA doesn't mean that I don't possibly be able to do a USDA 0% down. USDA 0% down is actually easier than doing a DPA. Okay. So it depends on the situation of the borrower. That's number one. Okay. And where we're buying at. But I just want to give an example. So this is the website that I put in the link. Okay. So if you looked at it, the entire United States, and then we can just put an address in here. I'm going to put my address in here because I live in Kansas and I might qualify. I have no idea, but, and especially my birthday's coming up in December if someone wants to send me something. So I am right outside the zone of where I'm at. This address is not located in an eligible area. I would not be able to buy this home. But if I look, you know how Josh is talking about it, if I look one street over, the neighborhood up, they do qualify.
Yeah.
Okay.
So the property has to qualify. What are some general guidelines for the borrower?
I like to see at least a 640, and then they have to have fairly decent income. Like income can't stretch real far. What I mean by that is they want their front end ratio of their gross income to be 31% and their back end to be about 43 at minimum. So they can't overextend themselves a lot on this product. Where DPA, like maybe they don't qualify for USDA, maybe it is in an area, but their income doesn't. We can just swap it to FHA. FHA will go up a little bit higher on that, where USDA might not. But this is the first thing I look at every single time I'm talking to someone 0% down. It's not us as originators. You should be looking at it every single time, because it is a product out there, and it is an easier product typically when you're going through the motions to do USDA than to do a down payment assistance program.
Here's what I would highly recommend for all of you on here is just create the curiosity and open the conversation, and let Jordan or someone on our team then do the exploratory process to identify which program is or programs are going to be the best fit, or do we need to provide some credit direction and give them a plan so that they can make their goals a reality, right?
Yeah.
The idea behind these info sessions is to give you enough information so you can have an educated conversation, but you should not be trying to qualify folks. If they're interested and they're motivated, we'll figure out how to help them. Whether that's we can help them now, and here's the best way we can, or listen, ideally, let's do X, Y, Z, and let's touch base again in 30 days and see where we're at, or let's do this, that, or the other thing. Jordan, go ahead.
So with that being said, the other thing that I want to mention on this is on when we are qualifying them, or we are going through that process, it's not a one size fit all, right? You know exactly what Josh is talking about. It's I'm going to say 95% of my clients that are 0% down don't qualify today because they're 0% down, and they might not have the money, and they might have their credit a little wonky or whatever. But our goal isn't to get them into a 800 credit score, a 700 credit score. Our goal is to get them to a 0% down program 9 times out of 10, because I eliminate one of those pillars. My goal is to get them the fastest route to purchase a home, whether that's a USDA, whether that's a FHA, whether that's a VA, doesn't matter what it is. Our credit direction is surrounded, not getting someone to a 740, it's surrounded to, can we get them to a 640? It's a much different look at your credit. And it's usually a much shorter process too. The problem with it is a lot of times these people are lacking money, right? So it takes months to cultivate. You really see your benefit after 9-10 months.
Totally.
Okay.
From Lynette, are there any 94506T programs available? And if so, what's the criteria to qualify? And W2?
Not ibuprofen, but acetaminophen.
Yeah, go ahead.
I heard cinnamon. Yes, absolutely. Let's go through them. Wasn't our last one that we did 5 non-QM programs? I think I did it with Ryan. It might have been the last one.
2 ago.
2 ago. We do have this actually on a YouTube webinar where we do a whole info session like this about all the non-QM programs and some extras in there. But we do have 1099 programs for borrowers where we just average the 1099s. We don't take, and this question is usually directed towards real estate agents a lot. That's where real estate agents will use them, because most real estate agents are 1099. So there are loans out there that do allow, or non-QM products that do allow you to not pull a tax return, right? And go off of net on your tax return. 1099, you got the community program with change, which is a higher credit score. If I have a 740 credit score with 20% down, I don't need a job at all. I don't even have to ask them about your income. The 1099 program with Rimmon, I think that's 10% down. I need to double check on that. But basically these programs are out there. There are programs made for 1099 employees and self-employment borrowers that allow them to buy primary and investment properties.
Peter, unfortunately, people see zero money down and think zero out of pocket. I get what you're saying. And also, like, if somebody wants to rent, they're going to need first and last month's rent and security. And in many cases, if they have that, we can, with some negotiation and creativity, potentially have doors open to them. And also, like, anytime you use this as a conversation starter, you are going to have to sift and sort through folks that aren't realistic or qualified to find the ones that are. But listen, we're in a market that I think we all can agree is challenging, right? You got to work. You got to do the work. And it's work worth doing. And when you do the work to help clients with these kind of programs, they become some of the best advocates for you and referral opportunities for you for two reasons. Number one, they will, in many cases, go out and talk about you and how wonderful you are. And number two, people within their sphere of influence are going to think, so-and-so just bought a house. How did they buy a house? If they could buy a house, I can buy a house, right? And then they're going to ask so-and-so, how did you buy a house? I didn't think you could buy a house. And then that becomes a referral for you. So I get the point, Peter, but let's focus. What you focus on expands. So if you focus on the folks that are this way of thinking, you're going to get more of those folks. If you focus on the folks that are motivated and willing to listen and learn and do the work necessary, you're going to get more of those. Let's see here. Can you all assist with VA location clients? I'm not sure what you mean, Danetta. I'm not sure what that means. And feel free to open your line. I think you can open. I think folks can open. Oh, Virginia?
Oh, yeah, absolutely. I thought you were talking about VA.
Oh, that's what I thought too. Yeah. Absolutely. So
the VA loan, no, they can't. It can't. To answer your next question, yes on the first question. The second question, no, it cannot. VA loans have their own guidelines. This program would have its own guidelines. It's a completely different program.
And the second question, just for those that missed it, if you're not seeing the chat or you're watching the replay, is can a 1099 program be combined with a VA loan? You can't combine those two. But let us figure out how we can help those folks. Let us figure that out.
There's one other thing I want to mention on USDA, because Isabel is making a good point here, is USDA is actually dependent on family size and county as well, on if they can buy. So there's income restrictions there. So I'm going to give you a little back of house on this a little bit, and we'll go a little bit deeper on it. But essentially, let's say, and I know Isabel is in California, your income restrictions for your higher price loans will be based off of your area. It's not going to be based off of anything, but it's also based off family size. A single person buying a USDA home has a certain income. 2 people have another income. 3, and then 4, and then after 4, it doesn't go up very much after that. But also with that, you have to consider even children in the house that are working. So Josh's kids, I'm pretty sure that work a little bit, but if they claim any income on at all, that would be considered also into that income. So if you have a 16-year-old or 17-year-old working, we do have to consider that income as well into that calculation.
There's been several instances on this session here that illustrate the importance of knowing the right questions to ask a potential borrower. And that's one of the values that our team brings, is knowing the right questions to ask, knowing to ask, about.
Do you have a 16-year-old? Yeah, if you have a 16-year-old, do they work? Right. I have been burned on that. I promise you. I've had at least once in my career, I've had to figure out and shake and move on a file just because that question wasn't asked. I'm going to tell you, 99% of originators want to ask that question. But you burned me once, I'll never forget it. So, but yeah.
Robert, what's the best link to have borrower to go to start the qualification process? No, not at with Josh. Go to if you have a warm referral. Actually, I'm just going to copy and paste from the very top here. For whatever reason, the chat doesn't carry if you weren't on at the beginning. If you have a warm referral for our team that you would like to work, there's a submission form that you can submit, or you can just reach out directly to Jordan and make the handoff that way by text, by email, or even by phone. And we will treat them like gold and make sure that we're following up and identifying which of these programs or other programs might be the best fit. Go ahead, Jordan.
I don't know if a lot of you have worked with me in the past. I typically answer pretty quick. I want to be honest. Like if you email me, I'm emailing you back within, I would say, a fair amount, a quick amount of time. So if you have a client, even if you submit it to a warm referral, if you send it directly to me, I typically have it handled very quickly. At least appointments
Also,
set with them.
Let me throw this out too. Like our team, we have our own Zoom room where our team is
you can drop it in the chat. Let's drop it in the chat here. I sit in this room all day besides on these calls like this that we do, or the morning show. You guys can hop in every time. I think Stacy has hopped in with me before. But that link right there is our team Zoom room, and I'm in there all day long. So if you wanted to stop in and just say, hey, I want to talk to you about a client, maybe you didn't want to call me, you can hit, get me on the Zoom there. If I'm available, I'll actually, I'll stop and talk to you. And then, but if I'm not, you can always text and email me as well.
And what happens when you go to that Zoom room, it's kind of like a virtual office. You will be, you'll when you land there, there's a front desk, and someone on our team can then put you into Jordan's room, or if you're working with somebody else, someone else's room, and you can hop in there and have that live interaction. And George, if you would like to do a 3-way call with a client, absolutely. I mean,
yeah,
we do that as well for sure. Let's see. Sky, if you have a question that you don't want to cover here, just reach out to Jordan, email or call or text Jordan. And
actually, it's a 3-way for the 3 of us, because you guys have a client of mine and there's a situation, and I wanted to talk to you guys about it.
Yeah, we can.
Okay, well, there's no, I can assure you there's no value in me being part of it. Jordan, because when it comes to situations and scenarios, Jordan is the wizard with that. Yeah.
Okay.
Yeah. Let me call you. I'll call you right after this.
Okay.
So, I should. Yeah, I have time. I'll call you right after this. So
one thing I want to highlight, someone had sent this as a private question, but it's a valid one. Winifred on my team asked, what's the difference between Axon and Nexa Mortgage? Okay, because Axon is what I have over my head here. Axon and Nexa are parent companies. They're part of the same, and you don't need to know the particulars per se, other than to know that the way we have structured our team provides us with the greatest amount of options and flexibility so that we can best help every client and win on rate, on fee, on program, on any. There are very, very few situations or scenarios where we can't provide the best option for a client. And if there is, we'll tell you that too. If there is a local program or whatever that we just can't match, we're gonna tell you, because we're in this for the long haul. We're in this we're playing the long game with this, right? It's why we offer credit direction. It's why we built systems to follow up and follow through with clients 3 months, 6 months, 12 months, etc. Right? We plan to be in this business in perpetuity, and so knowing that, why not play the long game? It's not about who can we get pre-approved and under contract today. It's how can we help the most people right now while also building out your pipeline and our pipeline 30, 60, 90, 3, 6, 9 years from now.
Can I give a very specific example of that on the difference?
Yeah.
So US Bank is not a broker, like that. You can't broker to them, necessarily, but you can be a correspondent with them. They have a very, very good jumbo loan. So when I'm thinking about markets like Isabel's or California markets, I need to make sure that we have enough products to serve every market. We have over 220 lenders with over 40,000 products just on the Nexa side. And now we are adding the Accent side, which is more of a, those are the, hey, you could do a loan through Wells Fargo kind of thing, right? It's a different structure.
Andre pointed out that the link's not working. I don't know why it's not working, but you're right, Andre. It was working yesterday when I brought it up. I will have to get with Ryan on that. In the meantime, just email Jordan or I. Just email Jordan or I until we can get that. I don't know what. Did I misspell something? I don't think I misspelled anything. Let me try one thing here. One other thing that I wanted to mention as far as our team goes, and this relates to, yeah, I don't know why that URL didn't work, but this one does. I have no idea, but we'll have to get with our tech team to figure out why. This link should work. For some reason, without the www, it doesn't want to come up. Are there printable promotional flyers, Peterson? We do have some of that. Some of that is on the wakeup.realestate site. If you have something specific, just reach out to us. Someone, Danetta asked, can we help in Virginia? So we can't help in all 50 states. If you're not sure, just reach out to us. We have a growing number of states that our team is licensed and able to do business in. For example, we just added Minnesota, which Peterson's in Minnesota, and Washington, the state of Washington, which, by the way, Seattle, Washington is another great jumbo area as well, which ties into what Jordan had shared there. But if you're not sure, let us know. And if we can't help, we'll do our best to find someone in the state that you're in that can. There are certain states that have distance requirements, and then Accent and Nexa, specifically Nexa Mortgage, is open in 48 out of 50 states, but Massachusetts and New York are a bit of a pain. So there are work in progress as far as having availability in those states. Winifred, I have 3 referrals, 2 VAs, 1 in California, 1 in South Carolina, 2 reverse mortgage. So South Carolina is one that's a little bit tricky, but Winifred, get with Jordan. Let's get it going here. All right. Any other questions, comments, scenarios, or situations? Karen has to hop off. Karen, thanks for the referral of Simone and forget his name, but Jordan is working with
Tyrone. Yeah,
Tyrone. That's right.
Yeah.
Ashley, I'm new here. Do you service North Carolina? Absolutely, we do. Ashley, I would highly recommend connect with Jordan. Also, check out vqualifier.com. Vqualifier.com. That would be, again, nothing for sale here. This was just an info session. But if you'd like to explore how we can work together to be a rising tide in your business, you can check out vqualifier.com, which I will put in the chat as well again, or you can just reach out to Jordan or I directly to explore what we're doing, how we're helping folks, or like I said, if you've got a warm referral, and if you've got, we talk a lot about how we can help folks that have been turned down by other lenders or have sticky situations or scenarios, and we're great at that. And also, if you have a strong borrower, you should absolutely give us a chance to at least provide a second opinion, because we have so many lenders competing for our business. In the majority of cases, we can win on rate and fees. And not only that, we can crush it with A paper or strong borrowers. We can crush it in terms of getting clear to close. And in fact, the number one wholesale lender that Nexa as a company works with, our average CTC, clear to close, is under 10 days. So if you've got an A borrower, we will most likely have them ready to close faster than the seller and the title company and the settlement company are ready to do the transaction. It just means one less thing that you have to worry about or babysit. Jordan, any final words?
No, I'll check on a couple things. George, I'll give you a call, and then yeah, like I said, if you guys need anything, you can always email me. I respond pretty quickly, so it's not, you'll typically get responses within an hour.
Down payment assistance, USDA, VA, gifts of equity or gift funds, and then leveraging equity in existing property. We'll get the replay, the recording out later tonight or first thing tomorrow morning. There are resources on the site where you can use these ideas, these programs, to create conversation opportunities, to create appointment opportunities. If you need help, if you have questions, if you want to explore how we can help you convert more clients, go to vqualifier.com or just reach out to us directly. We'd love to chat. Everybody make it a great rest of the day, and we'll see you hopefully next week for another info session like this one.